Hey everyone, it's Matt Fox back with another financial tip, and in this week's video we're going to be discussing saving for college education. And in this video I'm going to go over a couple different ways as to how you can save and some pros and cons for each. If you do have any additional questions about any of the ways that you can save for college, you can either shoot me a message or give me a call. My information's in the description below. Before I get into it, make sure you subscribe to our channel as we're always trying to put out helpful financial tips. I'm first going to cover the main two options that we use with our clients when planning for college. The first option that I wanted to talk about was a 529 plan. A 529 plan allows you to save for college, get a little bit of a state tax write-off. All of the gains that you have in your account, if you use it for a college expense, come out tax-free. And also, only 5% of the balance goes onto your FAFSA form. The only real con to a 529 plan is that if you don't use those funds for college expenses, then you're going to have to pay tax on all of your gains and you will receive a 10% penalty. The second way that you can save for college is actually through cash value life insurance. Cash value life insurance allows you to put money away, and when you actually go to withdraw those funds, it comes out tax-free. Another pro for cash value life insurance is that it doesn't show up on a FAFSA form. And if you don't use those funds for college, don't worry, you're not penalized and you still won't pay taxes no matter what you use it for. The only con for life insurance is that if you pick the wrong plan, you could actually have some pretty high internal expenses. The next three options we don't use very often, but in certain situations, they can make a whole lot of sense. And the first one of these three options is the Coverdell IRA savings account. The pros are it works sort of like a Roth IRA. All the money that you put in grows tax-free. Another pro is that you can use this for any level of education. Some of the cons are that there's income limits as to when you can contribute. You can only put $2,000 away per year, and you have to withdraw these funds by age 30. The next options are UGMAS and UTMAs. These are accounts that allow you to transfer your money to your child. And a big pro is that any gains that are in that account are taxed at your child's rate. So chances are your child doesn't have a whole lot of income, so they'll be paying next to nothing on gains. The big drawback to these accounts is that you actually are transferring your funds to your child, and they get access to those funds at age 18 to 21, depending upon which state you live in. That means that you lose complete control over those funds once your child hits 18 to 21. Also, once your child receives those funds, it's going to drastically impact their ability to get financial aid. The last way to pay for school is actually using your traditional or Roth IRAs. If you use your traditional IRA, you will have to pay tax on that money, but you will not receive a 10% penalty even if you're under the age of 59 and a half. Now with the Roth, if your funds have been in for longer than 5 years, they are tax-free and you will not receive the 10% penalty. The big drawback to using your own personal retirement funds is that your retirement in the long run could drastically be impacted. Thanks for watching, and I hope this tip helped. As always, don't hesitate to reach out if you do have any questions about these topics. See you next week.